Hi guys, hope everyone's well. We're going to be running through everything in a few moments or so. We're going to be looking at all the 2024 predictions. We're going to be looking at what we predicted actually back in 2023. Were we correct? How far off were we? And so we're going to give everyone a few more minutes to join. Right, guys, it looks like the majority of us are here. We've got quite a few people tuning into this one. So just while I wait for the last sort of few people coming on, as I just mentioned a moment ago, we're going to run through everything to do with 2024, what we feel is going to happen in 2024. We've also already done a video on this. We're going to send this out to you after. We're going to send the webinar along with our bit more detailed video on why we feel 2024 is going to go the way it is. But what I'm also going to run through in this video is 2023, our predictions. We had a mixed bag last year in terms of, from a client's perspective. We had two distinct type of clients. We had the long-term view clients, which is the clients who would typically go and say, do you know what, it doesn't matter what the market does short term, I'm going to go and buy, that's it. And then we had the client who thought, do you know what I'm going to do? I'm going to wait. I'm going to just sit on my hands, maybe for 6 to 8 months, and I'm going to buy once we've seen a 10 to 15% dip. Now, as much as we can tell someone, look, don't wait for that particular dip. So sometimes you just can't teach a client what to do. You just have to let them fall on their own sword, so to speak, in the nicest possible way. But the reality is that you should be looking, anyone who's on this call now, anyone who's thinking about buying property for an investment, if you are thinking 6 to 12 months, you should not be buying property. It's that simple. You only buy property as an investment if you're thinking 5 to 10 years plus, because that's the time it takes to really see the investment mature. Now, it depends on what stage of life you're at as well. We've got some clients who might turn around and the older generation who think, well, I might need that liquid money ASAP. Again, we would advise don't do property. If you've got a property, it might take several months to sell. Normally we're pretty quick with it, but again, sometimes we have clients who are asking more than what the property should be, so it might take several months to sell. But the reality is that if your investment is good enough, the property will sell in extreme rapid time. So, but we'll come to that after, and we'll come to why people don't make money in the property market, because there's lots of reasons why people don't make money. But let's first of all talk about our predictions and where we think things are going to go. Well, first of all, I'm going to share my screen now, and I'm going to play you, and hopefully you'll be able to hear it through the speakers and back through the mic again. I'm going to play you what we actually predicted in 2023. And on the screen at the same time as well, you will see what the other predictions were. So as I share my screen now, what you'll be able to see is all of the other predictions that were actually there from, CBR, Jackson Stop, Zoopla. And as you can see, the 2023 forecast was all pretty much negative. There was a couple there that were flat. Hamptons, for example, thought it was going to be a flat year, but they're all negative. Up to Oxford Economics thought it was going to be a negative 12% year in 2023. And then we'll actually come on to what did happen. But let's just take a sort of brief 1 minute listen about what we predicted, and then we'll go from there.
On certain properties back in September, from September. Now, but mortgage rates have, of course, affected it. So what's happened? Well, demand has slowed, but now mortgage rates are starting to come back. We feel that rather than this huge crash that everyone's thinking, or some people have been 15, 20% in the negative, we're thinking a small correction, but the reality is 3% of that's already been factored in. We think probably we'll be looking at another 2 to 3% negative before we start to rise to the end of the year. We personally think the year is going to be flat, maybe even pushing 1 to 2% of an increase, because we don't feel that the economics are there to have.
So there you have it, guys. We thought that the year was going to be pretty flat, potentially pushing a 1 to 2% increase. Now, what did actually happen was we actually saw that the market went up, according to Halifax, 1.7% for the year. That was really buoyed on by the last 3 to 4 months of the year as mortgage rates started to come back. Therefore, liquidity and affordability was there. So that meant that people felt a lot more confident in the market. And because we didn't see that crash, because we didn't see that initial 10 to 15% fall that everyone was predicting, people started to think, well, actually, I think the worst of it is over. Inflation started to come back down, and people started to get the confidence back in the market. And that's really what investing is about. It's all about having confidence. And actually, it's about buying when people don't have that confidence. And what we said to everyone last year is everyone that bought through us last year could use the leverage of the lack of confidence against the developer. That's what you should have been doing. And we said this all the time, use the leverage of what's going on in the market news against the developer. We were getting bigger discounts last year than we've ever seen. Why? Because developers were reading the same news that you were. But now what's happened is developers have caught on to the fact that the market didn't dip, and they're standing firm. I mean, we had a client yesterday bought 2 units of 250,000 each, so like close to £500,000 invested, and the developer gave them £2,000 off. That was it. In my opinion, it's an insult. You're actually better to say, no, I'm not giving them a discount at all. To give £2,000 off for £500,000 investment is more of an insult. But that's what developers were doing. Wind back sort of 6 to 8 months, and we were seeing developers say, do you know what? Yeah, go and give them 30,000 off. But that's not happening anymore. So people missed out. And we had it a lot on our sort of blogs and on our chats where people were saying, do you know what? I'm going to wait. And we kept saying, don't wait. Now's the time. It's the same as any market. If you look at the stock market, when was the best time to buy? Well, when everyone's selling in 2020, when COVID hit, everyone's selling. The market come back down to just shy of 5,000. That's when you should have been buying, not waiting for it to go back up. It's the same with the property market. The difference is the property market's a bit more longer term. So look, we got it spot on. A bit of good fortune there as well. Don't get me wrong. We don't have a crystal ball, but the reality is we got it exactly right, between 1 to 2% of an increase, and that's what happened according to Halifax last year. Now we're going to then come on to this year. So look, let's have a look at what everyone's predicting this year. I'm going to sort of share my screen again, and I'm going to show you exactly what's being predicted this year. You can see on the screen now that you've got the Office of Budget Responsibility. Well, you can forget about them. They get everything wrong anyway. That's the irony about this particular organisation. But let's go for more of the higher players in the market, the Knight Franks, JL, Savills. They're all predicting a 3 to 4% fall. Even Zoopla and Halifax are predicting a negative. And then you've got Pantheon Macroeconomics predicting a 5% increase. We don't actually feel that's going to happen overall for the year. We're predicting, and I'll come on to why in a second, but we're predicting more around about the sort of 3 to 4% increase, give or take. The reason why is, and I'll tell you how I think it's going to pan out. I think we're going to see the first 9 to 10 months of the year go great guns. And I think by the time we get to October, we will see a 5% increase. Now, why do I think that? Well, I think because what's going to happen is a bit like last year, people are going to start to realise, well, mortgage rates aren't as bad as what they think they're going to get to. We've seen a slight stutter in terms of the inflation of the recent numbers. They thought it was going to be pegged back slightly more, but there's talk about energy prices coming down 14% over the next month or so. So we see naturally, again, another caveat to that is there's a lots of things going on in the world at the moment with the crisis that we've got and, countries, wars and things like that. So that may have an adverse effect, but we think that that's going to be minor in comparable to what's happening here. So we don't think it's going to affect us. So we see inflation coming down, and I actually see that the first sub 4% mortgage coming in the first half of this year, because I think what we'll see is the second quarter, we'll start to see the Bank of England pull their interest rates back, albeit very slightly. That breeds a little bit of confidence. They can't go too dramatic, of course, because that could have an adverse effect, but maybe 0.25% back. Mortgage companies get a little bit more confident, lenders get more confident, and we might see that sub 4% mortgage. That in turn gives more buying power, and so we'll see the process go on. Now, there's something that we've got to look at. There's a sort of curious twist of fate that we've got to look at in a minute, and I'm going to explain that to you about the rental market. But the reality is, I think that we'll see the first 10 months, and especially towards the summer, which is normally buoyant in the property market. People are more willing to go out in the warmth rather than in the rain to go and view properties. So I think we'll see things increase. I think 5% by October. The reason I'm saying it's going to end around 3 to 4% is because I think we'll see a pullback. And why I think that is because it's election year. We've got a gut feeling that they're going to look at election sort of November time, mid-November. Once that happens, people put plans on hold. They don't know where they're going to invest. They don't know what's going to happen. Now, this is as uncertain as I've seen it in an election. I know a lot of people are saying, well, Labour is a shoo-in at the moment, which I probably tend to potentially agree with. But there's what's called the shy Tory in the UK, and I think that could have a different effect. Certain constituents have been sort of rebordered. So there's a lot of things to take into consideration there. We don't know what's going to, how the SNP are going to play out in Scotland. So there's a lot of uncertainty regarding the election. And people then start to invest once they know the outcome, and not only the outcome, but actually the long-term effects of what the new party is going to do. Are they going to change any legislation in regards to the property investing? Are they going to change taxation? So they need to know that before making a decision. So I think what we'll see is 10 months of good gains. Not as good as it was in 2020, 2021 mind, but still solid for the year, 5%. And then I think that we're going to start to see a little bit of a peg back as things get uncertain. And of course, coming to the winter months, we typically see people don't want to go out and do viewings anymore. And they certainly don't want to start to have people traipse around the house when it's windy and raining, etc. So that's our prediction. And we're going to sort of put this on YouTube like we did with the 2023 predictions. We put this on YouTube, on our website. So we're going to sit in 12 months and see how close we were. If, hopefully we were pretty spot on. Now, then there's the curious twist of fate that I say. I had a client on the phone last week, and he said that he wants to invest in a property, but he wants to do it in an economy where everyone can afford a house. So he wants the most buoyant economy. Now, that's actually ironically not what you want. If you have the property market where everybody could afford a house, well, then no one rents. So what you want, actually, ironically, is you want a situation where people can't afford the properties. We want a situation where, and as you know, people might agree or disagree with this morally, but the reality is to create the most buoyant rental market, it means that you've got to have a rental market that can't afford to purchase. Now, in certain cities and city centres, they're outpriced. So if you take the average wage in London compared to the average property price, is a massive disparity. So that's why the majority of people in London rent. And you're starting to get that in cities like Manchester and Liverpool. And ironically, as an investor, that is what you want. You want people who are first-time buyers. They can't afford the 1 or the 2 beds. So the rental market goes up. And the rental market is predicted to be as buoyant as ever in 2024. It's predicted to increase dramatically. So if we can end the year and get you 3.5% to 4% growth and 7 to 8% income, you've had a fantastic year. Now, excuse me, what we say to people as well is that you do need a 10-year plan, because the likelihood is over the 10 years, there's going to be dips, there's going to be obstacles, there might be a change of legislation. But if you've got a 10-year plan, you should comfortably be thinking about doubling your money. If you don't double your money within 10 years in the property market, which is a combination of growth and income, then you've invested in the wrong product. It's as simple as that. You've invested in the wrong area or the wrong product. And what people typically do is they go cheap. They try and go cheap. They think, well, do you know what I'm going to do is, rather than buying a city centre in Manchester, I'm going to go and spend my 200,000 that I've got, and I'm going to go and buy 3 properties that are 70,000, 5 miles from the city centre. It doesn't work. Why? You have low occupancy rates. You have big void periods. You have tenants that don't take care of your property. Think about the tenants that you want in there. You want someone that's in there taking care of that property. So you want young professionals who are, you know, going out to work during the day, no wear and tear on your property. They're at night taking care of it. And the reality is, you don't want people that are going to wreck the place. Families, again, I've got 5 children, so I know, you know, for example, you have your walls painted and then a day later they're literally scratched up again. That's what you don't want, ironically. So what you want to do is you want to have people that are going to take care of that property. And the best properties that we have, where we have nothing to do on them, is where we have that younger demographic. You know, the first-time workers between 23 and 28, they are the perfect tenant. They're more liquid, and that's the tenants that you want in there. So the reality is, guys, think of this as a 10-year plan. Think of this as something that you are going to be hopefully doubling your money over that 10-year period. And that's our predictions for 2024. Now, I'm going to hand over to you guys. You should have a question mark. You should have a hand raised, anything like that at the bottom. I see we've got a few questions already. Is there any questions that you've got that you guys want to ask? I can see a few more coming through. So the first one, in terms of areas, have the areas changed what you'd recommend? Not particularly. It's a good question. We had a client earlier in the week that said he wanted to buy the next Manchester. What's the next Manchester? You kind of don't need the next Manchester. The next Manchester, you know, stick with Manchester. We just need to find that needle in a haystack. It was easy 10 years ago. You could put a pin in a map in Manchester and you could have made money. It's a lot more difficult now, and you kind of need the expert help more than before. But there are still great areas in Manchester that have been undeveloped, untapped, where the council are going to spend a lot of money. The same as Liverpool as well. You look at Liverpool city centre, it's been phenomenal in terms of the growth in Liverpool city centre. But things are starting to move onto the outskirts at the moment. And again, when I say outskirts, I'm not talking about that 5 miles from the city centre. I'm talking about things that are, you know, a 5-10 minute walk from the city centre. Things are starting to get built up there. And that's where you want to be, because if we look back to what we recommended 10 years ago, you know, in 2014, we were recommending Media City when Media City in Manchester in Salford was pretty much at its infancy. And I remember the biggest objection at the time was people were saying, well, it's Salford. I don't really understand why you'd buy in Salford when we can buy in Manchester. Was because we want the up and coming areas. And then a couple of years ago, it was like Trafford. That was the area that you wanted to go to. But there's still those opportunities. So yes, I would still say it's the same areas as a whole, but we need to be a little bit more specific in where we buy. It's not just the case of, you know, our job was relatively easy 10 years ago. It's become a little bit more difficult. And that's why you've seen a number of companies do extremely well in the industry and other companies go by the wayside because they just didn't have the research department. In terms of average prices, what do I need to invest? It's what you should invest, what you're comfortable with investing. There's not anything set per se. What we would say to you is, if you've got around 200,000, we would probably still advise you push to Manchester. Anything sort of sub 150, we would probably say, you know, you're pushing sort of Liverpool and some maybe secondary cities. But it's what you're comfortable with. We certainly don't advise that you push to your maximum budget and then you feel uncomfortable. It's not what investing is about. It should be enjoyable. And we will handle the whole process for you from start to finish. We deal with the furnishings. We can put you in touch with lawyers, mortgage brokers if you need. If you don't need and you have them, fantastic. We do all the management from start to finish. So, but yeah, in terms of investment levels, we can find something for you regardless. If you have around about 30 to 40,000 and you can get a mortgage, you can still invest. If you've got 30 to 40,000 cash and you can't get a mortgage, that's probably a no-go. So I would say if you're cash only, you probably need a minimum of 80 to 100. If you can get a mortgage, ideally you need 40 to 50,000, 30 at a push, but 40 to 50,000, that should enable you to get on. In terms of the whole process, should we be looking at our own area in local to us? A lot of people do that. A lot of people look local to them. And because of that, what they tend to do is they know the area, so they feel comfortable with it. But that's part of the problem. They end up driving past it, checking in on it. And what you end up doing is making 3% there when you could be making 6-7% elsewhere. The idea of any investment, whether you put your money in the stock market, is, you know, if you invest in a stock on the stock market, let's say you invest in whatever, Vodafone, whatever it may be, BT, you don't suddenly want to go to their headquarters. The reality is you invest in it because you think that it's going to make you money over the next X amount of years. The same with a property. It's just an investment vehicle. It doesn't matter what it looks like. It doesn't matter if you would live in it or not. It's just a pure investment vehicle to make as much money as you can. Simple as that. So we always typically say to people, just go to the area that's going to give you the best money. It's no more, no less than that. What's our predictions for mortgage rates during 2025? I'm guessing you might mean 2024, that then 2025 is a bit further away, but let's say 2024, we think they're going to be come back. What the lenders want is security. When you have something like what we saw when Liz Truss come in and we had the mini budget, and then you have sort of spot rates, bond rates all over the place. Then what then happens is they have uncertainty. And what we saw, where you would have a lender on the previous day turn around and say, this is the rate we're lending. And the next day they said, we're not lending anymore. And we had that over a period of 2 to 3 weeks where lenders were just literally saying, you know what, we've shut up shop just for the time being. We'll get back to you. So mortgage brokers were having a nightmare time trying to get mortgages for people during that time. The moment lenders feel that there's stability in government, stability in policy, stability in inflation and the market in general and the Bank of England's rates, then you start to see rates come down. They feel more comfortable with where the rates are. So I see rates coming down. I don't think we're going to get back to where we were, where we saw some mortgage rates at 1.8, 2%. I don't think we're going to get back to that level, but I can see them coming sub 4 this year. And I think we come sub 4, then that's going to really push the market on. In terms of your charges, how do you make your money? We're straightforward. We get paid either from a developer or we charge an admin fee. Now, typically, we charge an admin fee, and we do that. Some companies don't. And the bottom line is we will do so much more. I know most companies say that, but if you look at what we do, it's the same as saying, well, you can have a bank app, but you can go and bank with a cheap bank app online, and they will do your bare basic of what a bank would do, the bare minimum transfers in and out. Or you can go to Coutts, the Lahore Bank, whatever it may be, and they will give you a much better service, a personal service. you will get what you pay for. And if you are going to do one property, you know what property you want. My advice is probably go and use someone else. They might be cheaper than we would. Simple as that. But the reality is if you're saying, you know what, I don't want just one property. I want a portfolio. I want a personal advisor, someone to be with me every step of the way. We have an open door policy here. We're in Canary Wharf. Come to us anytime. Again, you pay for what you get, guys. And also, we do the full management. We've got in-house videographers, in-house marketers. Everything is done in-house, and that just means it's just a one-stop shop for everything. You're not having to work, and you're not having to do anything for your money. Well, look, guys, that's kind of it in terms of the questions wise, and I hope I'll just have one more through. I've recently had experience with a high street bank that was not comfortable lending on property that is more focused on the rental market, as there is less of a home ownership. Most city centres would be more of a rental market. Correct. That's because you went to a high street bank. So it's getting a... Let me see if I can sort of block the sun out there, guys. Yeah, so because you went to a high street bank, you are 100% right. The chances of you going to a high street bank and getting an investment buy-to-let mortgage on a development that has 100 units and 50, 60 of those are investor-led and they're all for buy-to-let is slim. The high street banks won't do it. But that's why you need a mortgage broker. If you're just going to one bank, you're typically going to get turned down. They might lend on a house down the end of your street for a buy-to-let, but they're not really investor-led. The high street banks are there to do the majority of residential mortgages. So what my advice would be to you is speak to a broker. There are thousands of buy-to-let mortgages out there. You might not think it. You might think because your high street bank's only got 5 banks in it, that they're not there. But there are thousands of different types of mortgages out there for all different backgrounds, whether you're UK-based, overseas-based. So speak to a mortgage broker. They will be far better than a high street bank will. If we invested in an apartment through your services, is Airbnb or Booking.com allowed renting to guests? Yeah, it depends on the actual development. So it's not controlled by us. We will happily Airbnb and Booking.com and do short-term lets for you on anything. However, what we do have to check is that there's an allowance in the lease, or it doesn't disallow you from using that. So there are some leases which are just a no-no. They just don't allow you to do that. And there are some leases which say 100% you can. There are some which are a little bit more vague, and there's a bit of ambiguity there where it doesn't say either or. And what we typically do is we'll take a view on that. Well, the reality is we can go and do an Airbnb, but what we look to do is what we don't host is stag do's, hen do's, parties. We look to get as much detail from clients as possible. So we've got a certain type of clientele, because if you start hosting those kind of parties, then before you know it, you're going to be stopped to do that. So we vet clients a lot when it comes to our letting side. But yeah, we do the traditional lets and the short-term lets as well. Do you include overseas properties for UK residents? When you say include, do you mean, I'm guessing you mean sort of do we sell? Yeah, we do. So we have overseas properties. We have overseas connections, Spain, Portugal, Dubai, a number of Cyprus as well. And we can get most properties that are on the market. What we typically say is speak to a broker. If we think that, do you know what, we're not going to offer you much value, we're just going to piggyback on the back of someone else, we just put you in touch directly. We're not going to try and make money for old rope here. We want you to have the best service. So yes, we do. But what I'd say to you is speak to a broker and let them know exactly what you want, and they can help. Excuse me, guys. Well, look, it's been a pleasure. Sorry about the sun in the background there. And as I say, I look forward to speaking to you soon, and anything you need from us, let us know. You can see our 2023 predictions on YouTube. They're still there from a year ago. And of course, our 2024 predictions will be uploaded shortly. And I look forward to speaking to you soon. You take care, everyone. See you soon. Bye-bye.